Prices soared in 1928. General Motors, for instance, rose 75 points on the stock exchange in 2 months. RCA stock was 85 at the beginning of 1928. At the end of the year, it reached 420 and sold for $505 a share. Many people bought stock on margin, putting down 10% of the purchase price and borrowing the rest from brokerage houses. Banks bought stock and companies loaned banks money to buy more. When prices rose, people thought they were making money. However, if stock prices fell, borrowers could not pay off their loans with their stock. But few foresaw a stock market crash, and companies issued more and more shares to take advantage of ever-rising stock prices. Minimal government regulation allowed companies to issue shares with no underlying value. They were not required to certify the financial worthiness of investment holding companies or of banks that owned stock in major companies. The Florida land boom and bust provided a foretaste of the catastrophe awaiting Wall Street in 1929. Cheap land, warm weather, and zealous promoters encouraged real estate developers to invest heavily in Florida in the early 1920s. Entrepreneurs promoted it as a vacation destination and to investors looking to get rich off its new popularity. Humorist Will Rogers once said of Carl Fisher that he, quote, rehearsed the mosquitoes till they would not bite you until after you bought. Most investors simply intended to resell their property for a profit. Thousands of people paid increasingly outlandish sums for, quote, 50 feet in paradise. But speculation caught up with Florida by 1926. Investors discovered to their chagrin that much of the land they bought was unusable swampland or was permanently underwater. Many began pulling their money out of the state. In addition to irresponsible speculation, income disparities and rampant use of credit also destabilized the economy. The income of the wealthiest 1% of Americans doubled, while the income of the bottom third rose only 6% in the decade. Income tax cuts returned money to the wealthy but did little for the middle class or the poor. While rich Americans could keep on buying washing machines, refrigerators, radios, and cars, the bottom two-thirds found themselves stretched to the limit. By 1929, American factories, like farms, were guilty of overproduction. Manufacturers cut prices and then reduced their output. They laid off workers who in turn cut back on their purchases. Borrowers stopped paying their consumer loans, leaving banks and stores with millions in bad debt. Wild speculation, inequities of wealth, massive consumer borrowing, lax government regulation, international trade barriers, and excessive international lending culminated in a perfect storm on Wall Street. Stock prices peaked in September 1929 and then drifted lower. On Thursday, October 24th, prices fell sharply in the morning. At noon, bankers met at the offices of J.P. Morgan and announced they would step in to buy shares that afternoon, and prices stabilized. But on Monday, October 28th, prices fell again, and then on Black Tuesday, October 29th, the bottom dropped out of the market. Everyone wanted out, as banks and brokerage houses demanded the sale of stock to pay off margin debt. By the end of the day, 16 million shares, 3 times the normal number, traded hands. The stock market ticker, the record of trades, fell hours behind. All the gains of 1929 had been wiped out. By the end of November, stock prices fell to half of what they had been worth at their height. By 1930, people began to talk of major economic depression. In 1929, the unemployment rate was as low as 3.2%, but it shot up to 8.7% in 1930. Government policies made the depression worse. Secretary of the Treasury Mellon thought the downward spiral would correct itself. He said, quote, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. It will purge the rottenness out of the system. The Smoot-Hawley tariff of 1930 made it even harder for international manufacturers to sell products in the U.S. When other countries raised their tariffs in retaliation, the volume of international trade dropped from $2.9 billion in 1929 to $2.1 billion in 1930 to $1.6 billion in 1931. The Federal Reserve made matters worse by raising interest rates and shrinking the money supply. This mistake devastated the nation's banks. More than 1,600 banks failed during the 1930s alone, and millions of homeowners lost their homes to foreclosure. President Hoover tried to arrest the slide by encouraging voluntary actions to relieve the suffering of those out of work and out of their houses. He insisted that, quote, "the fundamental business of the country is on a sound and prosperous basis," end quote. But by 1931, few Americans believed him, and there was a widespread fear that this economic downturn was worse than any previous one.
Miami, I'm sweeping southward to Miami. Some little southward who waits beneath those Florida palms will soon be nesting right in my arms. I'll tell her how I've been scheming a love shelter for two to dreaming down by that shore where love found its start. Just me and my Miami sweetheart.